This lesson will be interesting for all of you who are into finance or want to understand the number that you get from a bank whenever you take a loan. So let's start. We'll start with NPV. So I have some cash flows here. So the first cash flow happens at year 0, so immediately it's minus 1,000, and then you have some cash flows happening at the end of year 1, 2, 3, and 4. How do we do NPV? We go here, equal NPV, open parenthesis, then you put the rate. I'm going to use 5%. If it's a monthly calculation, you need to divide the 5% by 12, and you'll have something that is more or less accurate. Then you'll select your values. If you select your values like this, you're making a mistake, because Excel will assume that this cash flow happens at the end of year 1, this one at the end of year 2, etc. So if you do this, you'll get 1172. The correct way to do this is to select this, and then at the end of the formula, you're gonna subtract your initial investment. So it's 1231, the right answer. Next, we're going to look at IRR. IRR, which is internal rate of return, it will tell you what should be the interest rate to make your NPV 0. So you write IRR, open parenthesis, select your data. You don't need to put a guess, which is the second parameter. It's just to help Excel try to figure out the answer, but you don't need to do it. You just say enter and you get 38%. Now, the problem can arise if your cash flows are not at regular intervals. So, for example, let's assume this cash flow, instead of happening in December, happens in March. And if you use this normal IRR formula, you'll get a wrong answer. So you could use the XIRR formula. So we're going to do XIRR, and then we select our values, comma, we select our dates now, and we don't need to put a guess. So we close the parenthesis and we get 40%. So if you see, for example, if this happens in January, my number will increase. So I'm just going to show you this. It's 40.1. When it was in March, for example, it's 39.54. So this is how XIRR works. Let's bring it back to December. Then we're going to use MIRR. MIRR assumes that if you have a positive cash flow, you can reinvest it. If you have a negative cash flow, you have borrowing cost. So in case you have this, you can use MIRR, and then you select your values. You select your financing rate. So for example, it's 5%. And if I get some cash, extra cash, I can reinvest it, let's say, at 8%. So then I close the brackets and I get a number. Next, we're going to look at some formulas. So a lot of times you go for a loan at the bank and then they tell you that your payment is X per month. So we're going to try to calculate this. In this example, I'm taking a loan of $100. So you write minus 100. Then the interest rate, I assume 5% and I divided it by 12 to have a monthly interest rate. Then the number of period, which is how many months I'm going to pay the interest rate, it's 48 months. And then I'm going to assume that my loan will be 0 at the end of 48 months. And I have the same data here, so we can calculate all the parameters of this formula. Let's start with the payment, which is the most common one. We're going to do equal PMT, open parenthesis. Then first we have the rate. So the rate is this one. Make sure that your rate is in the same unit of measure as your payment, as your number of periods, etc. So this is my rate. Then the number of period is this. Then my present value is this one. So we're going to select this cell and it should be negative. And then your future value is 0, and type you don't need to fill. Then you close the parenthesis and you get $2.3. Here I have my local currency, so it doesn't matter. So that's the payment you have to make for 48 months. Now let's assume you have the same parameters, but you want to calculate the present value. So you'll do equal PV. What is my rate? 0.42. What is the number of periods? 48. What is my payment? For payment, you have to do it negative in this formula. So minus 2.3. And then the type, the FV is 0 and the type is nothing. We don't put anything for type. We get 100, as you can see here. Next, let's assume we want to get the rate. we do equal rate, open the parentheses. The periods are 48, payment 2.3, PV 100, and FV 0. You get 0.42. And finally, we're going to do the number of periods. So N pair, rate, then you get payment, then you get PV, and finally you get FV, and you get 48.